Good morning. I'm Joe Terril, President of Terril and Company, private wealth managers headquartered in St. Louis, Missouri. Sitting here with me today is Russ Phillips and David Carter, portfolio managers and also members of our investment committee. This is Thursday, August 3rd, and another update on what our thoughts are on the economy and the markets. I'll start out, gentlemen, by basically saying what a volatile time we're living in now. So much happening, so much opinions about what direction the economy, inflation, and interest rates ultimately are going to take. As people who follow our videos know, we've been saying for a year, strong consumer, strong economy, and no recession in sight. And that has been very correct. And now that the Federal Reserve Bank has raised interest rates significantly, now the question is what's going to happen. As viewers know, looking backwards about what happened last quarter is not always a great idea. You need to be looking forward as to what's going to happen in the next 2 or 3 quarters. And that's maybe what we'll try and concentrate a little bit on here. We remain in the camp of no recession in sight yet. Consequently, interest rates are going to stay higher for longer. And we're not totally convinced inflation, although down from 9% to 4 to 5%, is anytime soon going to return to 2% to meet the Fed's goal. So, Russ, I'll start with you and ask, can you remember a time frame when things have been as volatile as what they've been? I still, and I know we've talked about it, and that's how we have portfolios structured, being very cautious. Yesterday's move in the market, following through with today's move in the market, these things can turn in a big hurry.
I think that's correct, Joe, and going back to your earlier comments, I think we have, and you have correctly stated, that the economy was going to be stronger for longer, and that has developed. I think the thesis that inflation is going to continue to be sticky has been our thought as well, and hence the Fed raising interest rates like they have. I think the question is the Fed done? And that's the million-dollar question that we don't know the answer to. But I do think the things we're confident about, the economy is getting strong, it continues to be strong. Inflation's going to continue to be sticky, and we continue to have a very conservative posture with the investment portfolios with that backdrop.
Yeah, I'm not sure who said it first, but a way for us to think about it and want to maybe get across with the viewers, the Federal Reserve Bank this time around is handling the raising of interest rates, etc., in a completely different fashion. This has never been tried before. This thought process of how should we do this has come out of some of the Ivy League universities, which are saying don't remove the reserves from the banking system, give the banks a higher interest rate and encourage them to leave the reserves with you at the Federal Reserve Bank. So we'll see. I'm not sure this is working as the Fed would want, because in the past the saying was the Fed will take away the punch bowl. The Fed's not taking away the punch bowl. The Fed's leaving it sit there on the bar. They're just charging a higher price for drinks. You can have all the money you want if you'll pay the price. In previous time frames, the Fed removed the money from the banking system, and there wasn't any money to borrow. And if you did want to borrow, you had to bid interest rates up and interest rates became a reflection of how much reserves are in the system. It's being done completely opposite. So I think some of the speculation, just wild speculation we've seen in the high-tech NASDAQ stocks and some of this is reflective of the fact that you can borrow all the reserves you want if you're a hedge fund, whatever particular may be. You just got to pay a little bit more for the money. So I really like that concept of thinking the Fed is just charging more for drinks. The reason I bring it up is I'm not sure that's going to work. A lot of people would have thought the Fed would have really slowed everything down by now. They haven't. And, you know, we're in the camp and of the Fed's going to have to raise interest rates a couple of more times to absolutely slow this down so incremental demand can come down and with that lower prices. But it's certainly not overwhelmingly happening.
Yeah, I think you can look to the Goldman Sachs Financial Conditions Index as a good example of that. Even though the Fed has tightened from 0 to 5.5, financial conditions aren't as tight as they probably need to be or should be at this point with the number of rate hikes we've had.
Yeah, it's refreshing, David. You work here in the company in this area to see the ability to buy short-term investment grade, near riskless investments, the old 6% or more. It's been a long time since we've been able to do that. But what I really want to talk to you about is corporate earnings. We're a month now, a little over a month past the end of the second quarter, and I know you're listening to all the analyst calls and following this. Is there a trend that you can tell people about what seems to be happening with corporate profits?
Well, for maybe the first time in a long time, corporate profits are now becoming very company specific, where company A may outperform and raise guidance, but company B in the same industry will miss and lower guidance, and that it's going to be much more. I like to think of it as the market is a forest, and you can say, hey, this is a good forest, but now it's a market of trees, finding the right tree, and in general, earnings are going to be down about 7% for the year on the S&P 500, and the market's pricing that in. The headwinds are employment, wages. The headwinds are interest rates. Companies are paying more for interest, and they're becoming a little more cautious about their earnings next year. It's not uncommon for a Pepsi say, hey, we're selling less Pepsi, but our prices are higher, and our prices are higher, earnings are higher. That fits into the inflation, longer camp. But in general, managements are having a harder time with their earnings because of wages and interest rates, flowing through their income statement. That's the main trend I'm seeing.
We'll see. We've discussed internally, obviously, as you guys know, and we've even discussed so much of this with some of our contemporaries, with the pay raises that we now see people get, and they need to stay up with the past inflation. The airlines, United specifically, given a 40% pay increase over the next 4 years. Federal Express, the grain workers, Kellogg's, talking about this. Will these pay increases be enough to keep the consumer spending. What about people at the lower end of the spectrum? Are they getting enough pay increases to continue to spend and keep the economy moving along? This is the debate, and for the moment at Terril and Company, we believe the answer to that question is yes. And the economy isn't going to boom, but it's a long way from going into a recession. Yet, we'll have to see. But interest rates will stay higher for longer, and as the longer term interest rates are now moving up, it will cause a major correction in some of the most speculative ends of the market. Fair way to sum it up?
Yep.
Yeah.
We thank you for joining us today, and Brian Curtis, who produces these updates for us, thank you. And we'll be back in 2 to 3 weeks with another update.